Tom, good to get you on Real Vision on the kind of launch of the crypto channel. I really wanted to get you here because I think your journey into crypto is really interesting, and then what you guys are doing at Fidelity, I think, is super fascinating, and it's allowing us to peer into the future. So tell us a bit about yourself, and then we'll go back a bit in time and tell us how you got here in the first place.
Sure. Well, first of all, Raoul, thank you for having me. It's an honor to be with you. And my quick background is I am president of Fidelity Digital Assets. I've been at Fidelity for about 2.5 years. When I joined the organization, crypto was not necessarily in my future. I joined as head of corporate development. And because I have some interest and background in the space, my boss asked me to get involved with what were then in early 2018, a collection of experiments, R&D projects in and around digital assets. And so for a fairly lengthy period of time, I wore 2 hats at Fidelity, and now I am exclusively running this business. Prior to Fidelity, my initial experience in digital assets probably happened around 2014. I was working at Goldman Sachs in a group called Principal Strategic Investments. And basically, we invested the firm's capital in strategic fintech projects. They were very much aligned towards traditional capital markets. So there are certain companies that your viewers may be aware of today, like TradeWeb, which is now a public company, IHS Markit, which started life as a provider of credit derivatives data. Those were companies that were all incubated in this group called PSI. And we probably, when I left that group, we were probably managing about 50 or 60 private investments and things related to fintech. And we worked very closely with, obviously, our sales and trading group, but also our technology group. And at the time, our CTO, who was very much I think the term polymath would be appropriate, very interesting guy, sent me an article about Bitcoin. And just given my, call it my bias as someone who was very interested in technology and the intersection of technology and finance, I can't say that I understood it at first, but there was something from more of a macro standpoint around hard digital money combined with the network economics or some sort of, call it publicly available venture investment, as it were. This thing that had these unique characteristics of being scalable like a technology company or technology investment, but also was effectively money or a new form of money. That's kind of where I entered the rabbit hole. And I have to say, that was my initial inclination. And the more that I understood the technology, I started also thinking about the implications of the underlying blockchain technology for a lot of what happens on Wall Street today. And so, people take sides in this debate. You're either a public networks person or, permission private networks person. I've always kind of surfed between the two because I see interesting aspects in both. And I think that persists to this day, although the growth in each of those areas seems to be moving at different speeds from time to time. So I originally looked at it from more of a macro standpoint, but then started thinking about blockchains as a new operating system for finance. And I still have a little bit of that view. And certainly the future success of our business plan is very much predicated upon the latter. We're not the Fidelity Bitcoin company, we're the digital assets business. And that has a much wider aperture, which would include the use of the technology for many different types of value, including traditional forms of value.
Yeah, I had the same thing when I first saw it. There was a bunch of ex-GS guys who showed it to me, actually, Bitcoin first time, 2012, 2011. At the time, we were going through the European banking crisis. There was questions about collateral and who owns what. And I just saw this blockchain and thought, okay, this is the answer to all of that.
What we're showing you here on our YouTube channel is just the tip of the iceberg. No matter where you are in your financial journey, whether you're a beginner just looking to break into the market or a financial professional looking to up your game, Real Vision has something for everyone. Every day, our team of expert journalists provides in-depth analysis, written reports, access to live streams, and access to our community, The Exchange, where you can interact with people just like you from all over the world. For just $1, you can unlock all of this and more at realvision.com. Try our Essential tier. If you like what you see, it's only $20 a month thereafter. So click on the link in the description, go to realvision.com, and see what you think. We look forward to seeing you there.
And then the more like you kind of fall into the rabbit hole of realizing there's actually an enormous amount of applications for this whole digital asset space overall.
Right.
So you go to Fidelity doing corp dev, I guess, looking at acquiring fintech firms and stuff like that. So how does a firm that's traditionally viewed as a traditional firm suddenly start tapping on the shoulder saying, hey, what about this Bitcoin thing?
Yeah. Well, look, Fidelity is a very private company. We're not touting ourselves in the press on a daily basis. And so I think that, certainly myself, working on the sell side, I always viewed Fidelity as a very important client, industry leading buy side institution. And then when you get here, you realize that even though Fidelity is synonymous with asset management and also private financial advisory, we have a pretty large institutional business. And then you also dig a bit deeper and you realize that Fidelity has a very long history of innovation, quite frankly, going back decades. I mean, the thing that I laugh about is, before you could trade on a website, Fidelity had a trading application they were distributing on floppy disks. It was called Fox, Fidelity Something Exchange. And they had people trading electronically with Fidelity back in the early 90s.
Wow.
And so when I joined Fidelity, it was quite a surprise to see a lot of work being done in the space. So as far back as 14 or 15, when quite frankly, I think there were very few people on Wall Street that were really digging into this and understood it. It was more of a hobbyist culture. Our CEO, Abby Johnson, was actually investing money and hiring people to mine Bitcoin, to run nodes of the Bitcoin.
How did she see this so soon?
Yeah, it was, as I understand it, it was part of a strategy discussion, and the theme for the company or the dialogue was frictionless capital markets. And somehow out of that discussion, she and others became very interested in blockchain. And given the firm's history, we had people working in the space, 5 years ago, which is an eternity for folks in institutional finance. And there are fun stories about, running pilots in the company cafeteria, allowing people to buy things with Bitcoin and trying to understand the user experience and quote unquote settlement. We've been mining Bitcoin pretty much continuously since then, very active in the industry. And so, when I got involved in 18, we had a collection of capabilities, walleting infrastructure, trading infrastructure. And the question was, where do we go first? Now, being Fidelity and having a large, call it individual investor business, one path was to do that. And I think we felt that on balance, where would we potentially get greater bang for our buck in terms of our capabilities? And that was really in the institutional space where we felt there was not a sufficient amount of infrastructure for an institution to allocate to the asset class with some degree of familiarity and safety. And so we decided to kind of point our efforts around institutional. We got funding to build the business, I think, in May of 18. We announced it in October, onboarded our first client sometime in early 19, and here we are, kind of off to the races. And that doesn't preclude us from doing things in other client segments in the future, but we're very much focused on how can we make this asset class more accessible for institutions.
So how did you onboard the first institution? That's always the hardest one, right? The first 3 or 4 are pretty tricky. You might get the first one is somebody who wants to do it. And then after that, you actually need to persuade people to do it. So how did that story go? How did you do that?
Well, the good news is they were Fidelity alums. They had been aligned with some of these projects at Fidelity. And so it was a very friendly engagement, clearly not the most seamless experience for the client, but fortunately, and we're very thankful that they were patient, they understood what we were doing, and they kind of bought into the mission. And then, to be honest, it is really an iterative process, because in some cases you're starting with no industry standards. And so a lot of what we did is we tried to look, and a lot of our model is we look at the paradigm in existing capital markets and say, even though crypto is very different, part of the value proposition is trying to disambiguate the weirdness in crypto and the way the market structure is different and present it in a form factor that someone who's primed at Fidelity or trades at Fidelity would understand. And so that was also very helpful to us, having that institutional pedigree where we weren't starting at zero. We weren't a bunch of guys in a garage saying, yeah, we worked on Wall Street, but what does a custody agreement need to look like? And how do the liability provisions work between the service provider and the customer? We had a lot of touchstones around the organization, and that was a huge help. That's really been for lack of a better term, an ace in the hole for us, is having that understanding.
So what are the services that you now offer institutions? I want to get the current state, and then we'll talk about where you think this is all going. But what do you currently now offer, and who are the kinds of clients that you're finding coming on board? Because everyone's obviously very keen to see how this space evolves in the institutional, high net worth, family office kind of space. So I'd love to hear that and the kind of services you're offering.
Yeah. So from a client standpoint, it is, the inelegant term I would use is sort of non-natural persons. So everyone from single family, multifamily office, registered investment advisors, traditional and crypto hedge funds, all the way up through pensions and endowments. And we should probably talk at some point in the conversation about what we think that progression looks like.
Yeah.
Because in some of our research that we did a few months ago also kind of confirms how the tide is rising and where it's rising and maybe where work still needs to be done. But those are basically our clients. And our approach, again, coming back to this idea of being an institution, serving institutions, and trying to disambiguate the crypto market structure, we had very modest objectives at the outset. First thing is, these are digital bearer instruments. Custodying a digital asset is materially different than custodying any other type of asset. So the base of our pyramid is a very strong custody solution, right? That has a mix of operational, physical, and cyber controls to ensure the safety of the assets. By the way, informed by the fact that Fidelity has, a larger cybersecurity organization than most crypto companies have employees, right?
Really?
Yeah, so that's part of the learning that we get by being this hybrid organization to some degree. And then the next, call it, level of the pyramid is what we would call access to liquidity or market access. And this idea that as an investor, you need to leave money on multiple exchanges if you're looking for a best price experience is very foreign to a traditional investor who's used to firing up EMS or OMS or some sort of trading screen, and they can see every market aggregated and can execute on the spot. So what we do is we aggregate liquidity on the back end, and the client faces Fidelity. We're not facilitating a bilateral relationship. The client is trading with us. We're sourcing liquidity from third parties, and we're trying to create what appears like a best price experience. And that's our intent over time. Right?
So are you essentially market making? You're having to take principal risk to do that, or?
No, we're not. I mean, we're taking risk in the settlement process, but we are acting as an agent as it relates to price provision. Effectively, the client's getting prices from multiple sources. They pick the best price, and we facilitate the settlement. And where does it go from here? We'll start to look at things like more of a traditional PV model. So we'll look at lending. We'll look at margin at some point. Right now, we only support Bitcoin. Our research has been consistent around the fact that traditional institutions are, I wouldn't say exclusively, but primarily focused on Bitcoin as their initial foray into the space. It's not to suggest that they won't be interested in other assets. Obviously, many of them are interested in Ethereum. But our, call it, asset rollout will mirror where we're seeing the client interest. Again, indexed to more traditional clients as opposed to your crypto native funds who, by definition, trade lots of these assets.
So the regulatory background has now changed, allowing banks to now custody assets. I look at that as code word for prime broking. So it kind of feels that, and we're talking about how things evolve, it kind of feels like the hedge fund space is the obvious space to move faster.
Yeah, I think so. As far as the OCC news, look, I think any progress on the regulatory front is clearly a tailwind for the industry. The fact that regulators are thinking about this, they're proactively addressing it, has been a huge development. Whether or not the long tail of banking institutions in the U.S. will suddenly decide to offer crypto services is in question. But certainly for the larger banks and traditional Wall Street firms, it does open the door for them to provide these services. And again, to your point, probably the tip of the spear there is probably around hedge funds for some of the larger prime brokers. We see a role for ourselves in that space. There's an aspect of a service that we provide where we can act as a service provider to another intermediary. So we can act as a sub-custodian or service provider for clients who have their own clients who want to trade the asset, but where the intermediary doesn't want to have to deal with everything we've been doing over the past couple of years. So net, it's a positive for the industry and probably marginally good for our business as we begin to kind of scale out some of these enterprise services that we're building.
So when we look at the evolution of the client base, where are you seeing the move? From me personally, family offices were pretty fast.
Yeah.
Some of the in it. hedge fund principals are all doing it themselves, and they're slowly hedge
That's
funds
right.
doing it. How are you seeing it? What's moving fastest right now?
I would say it's still in those spaces, but what you're seeing is for the family offices and the hedge funds, you're moving out of the early adopter phase and into more of, I don't know what the Gartner term is, maybe it's mass acceptance, but this idea that now more and more of these investors are coming to the market. So you're past the point where the principal of the hedge fund has a personal position and maybe is convinced his fund to invest. Now you're seeing more folks sort of objectively look at the space and say, hey, this is interesting. Some of which, by the way, has been precipitated by the pandemic. I mean, we saw a reasonably strong uptick in interest in late March, early April, even before the Paul Tudor Jones newsletter, which we thought was very interesting. So we're seeing, call it the addressable market in those segments probably expand. We're also starting to see interesting developments. I mean, you and your viewers have probably seen the news about MicroStrategy, a public company that's allocated to Bitcoin. We've spoken to a few corporates. We have a couple of pensions that we've been speaking with. Utility company that's looking to mine Bitcoin potentially and trying to think through how they would do that. We tend to see the evolution in three distinct phases. One is call it the phase, I guess, that you went through in 12 or 13, and I went through in 14 and 15, which is, what is this and why should I care? And then there's okay, now that I care, why should I invest in it? What does it mean for me based on my financial goals or my portfolio composition? And then it becomes, okay, how do I operationalize this? What does it actually mean to buy and hold a digital bearer instrument? How do I do that? Who do I do it with? What are the artifacts of my relationships with other financial institutions that exist in this relationship that get me comfortable that it's being done the right way? And I think, you've got people that are out of that pipeline, your family offices and hedge funds. You have more people that are through the first phase, right? They get it. It's been in the public domain now for 10, 11 years. And now they're kind of thinking about, is this a play for my alt sleeve? Is it part of my core portfolio because it has some diversification benefit? So they're kind of in that mode. That's where I'd say a lot of the more traditional investors are. And then I think we're waiting and we're expect to see more people moving into that operationalized bucket, which is now that I've made the decision, who do I do it with? And how do I make the right decision to actually execute the trade and get the risk on, so to speak? And we're seeing more and more of those move through the pipeline. And obviously the more traditional investors are at the beginning of that, but we're seeing more come out the back end. And that's a positive.
I don't know if you were at Goldman. I was there in the late 90s, early 2000s, late 90s, and the group that built the GSCI Goldman Sachs Commodities Index. So they came in exactly the same process. And I'm just seeing this repeat, and I kind of know how it plays out.
Yeah.
Because the GSCI, they built the indices, built tradable vehicles in swaps at the time.
Yep.
And there was no market for it. So the first people were most of the guys buying gold themselves, right? Because it was 99, the gold market was bottoming. Then it was trying to persuade institutions about diversification effects, of which the family offices said, no, we get this. We'll buy some commodities, kind of makes sense. There's an inflationary wave coming. And then the pension plans came and they allocated huge capital. That group, I think it came out of Goldman, but there's a few others at Merrill and others were building these commodity groups, brought it from a really small audience of which nobody owned it in the pension plans to suddenly a huge industry.
Yeah, and that was maybe a 15 or 20 year arc?
Yeah, exactly right.
Yeah, look, I think this is an important point because I think a lot of what I call the crypto press, and maybe they've kind of fallen off this a little bit, or let's call it the cryptosphere, not to single out the press, but there's this sense that, the institutional wave is hitting the shore, right? It's going to happen this year. They said that in maybe 18, 19. And I think, as you just pointed out, and I've observed, having worked around market structure investments for the better part of 20 years, it's really more like a rising tide, right? It's not a wave that's going to crash. I mean, look, how long did it take ETFs to get to some degree of prominence?
For those of people who just care about the price right now, the marginal increase in buyers will drive the price higher.
Right.
But it doesn't go from no capital to a wall of capital, as you say. It's just a marginal increase over time. One of the key things for me is simply put, Bitcoin at a $210 billion market cap is noise. But if it doubles from here, let's say it doubles this year, at $500 billion market cap, it's not so much noise. And at $1 trillion market cap, every pension plan is going to have a meeting about it, whether they do anything or not.
That's
So
right.
the more, I kind of think the entire market short calls, that the more the market cap goes up, the more it forces everybody in.
Yeah, exactly. It's well said. I've thought it from the concept of a Giffen good. The more expensive it is, the more people demand it. But that's not the appropriate terminology. But yeah, you're right. And I think we're starting to see a little bit of that. I don't suggest, again, this is more of a tide. It's not a wave. Interest is begetting more interest, but it's going to be a slow and steady process, probably at an increasing rate. But it's not going to be parabolic like the retail interest was in late 2017.
No, exactly.
Yeah.
It'll operate differently. So the other thing, there's some big things happening as well in the space. I know, our friend Hunter Horsley and a few others are trying to get an ETF off the ground. When do you see that coming? Because that's going to help the RIAs. And I guess internally, you guys are, whether you're looking at that, you've just launched a fund as well. So talk us through that whole kind of RIA opportunity, because that looks like the other big one.
Yeah, I mean, look, I think it's a great question, right? Because starting with custody, it's, again, slightly more difficult to understand, maybe quite a bit more difficult to understand than traditional custody. But at some point, I guess the thesis would be, why wouldn't people just own the stuff directly? But the fact of the matter is there are certain channels, certain client types, and certain people generally that just want something through an investment vehicle. And that's, you've seen tremendous growth in the Grayscale product. There are other people that are launching products. So something again, coming back to this paradigm of a familiar wrapper or experience, like taking this asset and wrapping it in some sort of structure, will hopefully open the aperture of the market a little bit, if not quite a bit. I think as far as the ETF is concerned, I think the SEC has been pretty consistent in some of their comments around the rejections of the ETFs, that there are a number of things that they're still concerned about. One is this concern about, market manipulation. I think there are probably still some concerns around custody as a concept, right? Because of the bare nature of these instruments and many other things. But, the fact that you've got so many folks that are pushing to do this and engaging with them, plus some of the regulatory movement with the OCC and elsewhere, success of the futures market, seeing professional investors using futures to get quick exposure to this. I can't predict a timeline. I've actually never done that. I've never given a timeline for anything or a price prediction, but I do think that these are all indicia of maturation of the space, which at some point will either create more appropriate market structure, more transparent market structure that the regulators can get comfortable with, or perhaps through the educational process, get them to the place where they see that these vehicles are in demand and can be provided in a safe way.
And the very fact that you guys are in the space and done a tremendous amount of work on what is custody and how does it work and the legal agreements and all the things must give people a level of comfort that this is solvable.
It is solvable. I mean, look, a big part of what we do, I would say, 40 to 50% of our marketing effort is really around education, right? And again, more towards call it the second and third levels of that process that I outlined. We're not teaching people what blockchain is, but we are talking a little bit about the investor perspective and then operationalizing it. So, and that applies everywhere. It applies with clients at a regulatory level. And, it's not rocket science. It does take a lot of work and you need to be tremendously thoughtful, but sharing that perspective and the fact that we've been doing this for a while and how we do it and the third-party attestations and all the things we've done to make sure we've built a very solid platform, those help, when you're having discussions with the regulators and others about some of these investment products.
It's just very tough for anybody to argue that it's not institutionally solvable if Fidelity have done it. Right. It's difficult for Goldman themselves or anybody else also to have that conversation,
right? Because
it kind of doesn't make sense any longer, because you guys are proving it out as trailblazers. This is how you do it institutionally. This is how you do it at the highest order of quality, and it can be done.
It can be done, and quite frankly, and how large institutions think and behave. It's the fact of the matter is that most big institutions don't like to take, nor are they set up to take call it early stage product risk. I mean, in the case of GSCI, yes, but what was the investment there? I mean, it was some quants and a data platform and calculating an index and then sending people out to sell that product. This requires a little bit of technical and operational infrastructure, But the fact of the matter is, at some level of market maturation, every financial institution will be able to do this. We just were first because it's in Fidelity's DNA, and but these are solvable problems.
Yeah, the good thing for you guys is it takes a long time to solve it. So it gives you a few years advantage. So talk me through, and it's probably not in your area, or maybe it is the new fund that you guys are launching. I know you just filed for one. I don't know what you're allowed to say and what you're not allowed to say.
Yeah, I really can't say much. But what I will say is, again, Fidelity's background in this space, you think about mining, you think about the work we've done to build the custody and brokerage business. We believe in the asset class. We're going to use all of our capabilities to figure out how to give clients exposure to that asset class in different forms. Clearly, investment products are in our DNA, or one way we think about doing that. So, we continue to explore and push all avenues, and that's one example.
Yeah, and you have an enormous client base and a sales force, so it's kind of it's a natural thing to look at doing. So, as you look forward now to where the industry can go. And now we're talking about the broader range of digital assets, tokenization, even portfolios run around tokens. And where do you think this is all going over the next, we don't know in the long run, but, over the next 5 years or so, how do you think this whole space is going to evolve?
It's really fascinating because I think, and I'm sure you've done this personally, I've had to kind of refactor my assumptions on a regular basis being in this space. In the early days, it was public versus private. It was, our private blockchain is going to take over the world, whereas public. And I think that seesaws. I'm at a point now where I think, both can coexist. What's been going on in DeFi has been incredible. The interest in Bitcoin has been incredible. But by the same token, it feels like a lot of these proof of concept projects that have been bubbling around Wall Street for a long time around putting traditional types of exposure on blockchains is starting to get a little bit of traction. And so, again, without making predictions, I think that we'll start to see use of blockchains in production and banking for certain narrow use cases, let's say on a 12 to 18 month view. So I think some of that is paying fruit. And I think, and I learned this from my early days at Goldman, when you're building, let's say, a new exchange, it never really was about the technology. It was about the set of incentives that you had to use to get market participants to move liquidity to your platform, right? One way you did that in the early 2000s in the equities market was, maker taker pricing and, rewarding folks for bringing liquidity, et cetera. But it was very much around the social construct. And so I think on Wall Street, I think the technology's probably gotten to the point where it's less a foundational question about will the technology work or not. And it's more about what is the social construct that will allow us to do something meaningful on a blockchain as a group, right? And so I think you'll see something over the next 12 to 18 months. And I think that will continue down a path, evolutionary path. I continue to think that Bitcoin probably, although you're seeing a bit of an uptick in terms of use of Bitcoin for its original intended purpose as a remittance rail or payments rail, and that's been ticking up. I still think the narrative or the label is digital gold. I think it's a digitally scarce hard asset. I think most of the people we talk to who are interested in that are evaluating it through that lens, not some sort of velocity theory of money where they're trying to figure out in 10 years' time if Bitcoin will be used for payments, and if so, what does that portend for its value? I think it's very much around the digital gold.
I've been looking at this on this side. I'm starting to come around the view that Bitcoin may end up being the world's highest quality pristine collateral. Because if we think about collateral, the current world's collateral really at the top of the pyramid is the US Treasury bond, right? Now, the problem is as collateral, it has two issues. One is you can issue more of it. Right. So the central banks tend to use what normally would be the business cycle of collateral shortage, i.e. there's not enough credit for everybody and the best creditors have the collateral. Well, the central banks avoid that now by issuing a lot more of it into these things. But by doing that, you actually lower the intrinsic value of the collateral because there's more of it, which is right. Part of the debasement of money. And when you look at Bitcoin, yes, it's a little too volatile still as an asset. But its pristineness as collateral is super interesting because it can't be rehypothecated because there's the ownership on blockchain,
Right.
which gets around the issue of who owns what. It's, obviously digitally transferred and everything else. It makes it a lot easier than gold to use as collateral because even gold tends to end up somewhere where you don't know if it's rehypothecated.
Yeah, exactly.
And it's all offsets the inflation risk or the fiat debasement risk over time. So if inflation's running at 2% and the Fed want to run this at, and they're printing extra amounts of money, you're not losing the value of it. So as collateral, it's super interesting. Maybe it trades at a premium. So I'm thinking about yield curve. Where do we get to with a yield curve for Bitcoin? And DeFi for me is just the start. It's the money market we're trying to establish. And we're not there yet because we haven't got through a cycle and we don't know what it is. But so I'm just thinking about the yield curve, where it would trade. Where does 30-year Bitcoin trade versus 30-year treasuries?
Yeah.
And I'm guessing that I was thinking, should it trade cheaper? But I'm thinking no, because in the world of pristine collateral, you need to get paid for lending your collateral a lot more. The collateral should be worth more. So in which case it should have higher yields, even though it's got lower risk, which is kind of a screwy concept for us because we're so used to it not. So anyway, I'm just thinking myself through all of this right now.
Yeah, I mean, that's fascinating, right? And I'm guessing that this is a thought that you're having at this point in time. It's not something you thought about 3 or 4 years ago, right? That is what to me is so amazing about the space, just how dynamic it is. And as we spoke about earlier, how you constantly have to rebase your assumptions about what the stuff is.
And also how little we all know. Yeah. And as you say, I don't make predictions because predictions are really worthless in an environment where there are so many new things going on. It's impossible to keep up on top of it. It's not like there's a bunch of banks working on derivative markets. We're talking about half of Silicon Valley, this whole kind of group of renegade finance people and a bunch of people around the world all doing stuff of which we've got no idea what they're working on.
Yeah, and you look at some of these these new DeFi projects that have launched, and just the uptake over the course of a matter of days or weeks. I mean, it's kind of astounding. And it's interesting for me, and perhaps for you, coming from an institutional background and thinking about, call it the sanctity of institutional trust and the banking infrastructure. And then there are a bunch of folks over here that are saying, we can do all of these things. We can lend money, we can escrow collateral, we can trade derivatives, and we can do that in a completely decentralized fashion. And you say, that's cool, but is that the new is that the capital markets infrastructure for a new technology? Or is that something that traditional finance will have to worry about on some time horizon? And honestly, I go back and forth on that on a daily basis.
Well, I've been thinking this through as well. And it's the token thing that really interests me on that level. Because, look, we're in a world where equities are all-time record high valuations, almost globally. Yes, sure, some are relatively cheaper than others, and et cetera, et cetera. And it's a very saturated capital market we live in. And the rise of algorithms has made it even harder to gain alpha or some sort of edge. But when I look at tokens and you think, okay, everything can be tokenized, physical and digital assets. And they can have different income streams, they can have different asset values, there can be different component parts, they can have different smart contracts embedded. Okay, so that's a really complicated world of new securities, of which there's likely to be millions of them. And somebody's going to have to provide liquidity, arbitrage pricing, relative valuations. So the asset management industry, I think, completely changes because the opportunity set, as you and I know, one of the reasons we're both involved in this whole space is the upside is so much larger than anything else.
Yeah.
And I think of that with the token opportunity, thinking, okay, so, it wouldn't surprise me in a few years' time, Fidelity, creates a token-based fund of which they use their bottoms-up stock picking expertise to look at this stuff. And my guess is the outsized rewards are much larger than the current opportunity set. And that's really interesting to me.
Yeah, it is, because coming back to the concept that gave birth to Fidelity's exploration of the space, this idea of frictionless capital markets. I mean, and again, on a long enough time horizon, what are the implications of every type of asset being on a blockchain of some sort? Well, one is atomization, where you can cut these exposures into an infinite number of parts. You can disaggregate certain financial instruments into its components. You can theoretically administer and sell those in much lower increments, right? Because you've automated a lot of the processing, subscription, corporate action. And you can also theoretically compose portfolios of theoretically infinite numbers of instruments without the attendant cost and do it in a very automated way. Like now, that future may never happen, but it seems like some version of that is the end state vision for not so much Bitcoin, but the underlying technology at some degree of scale. And that's incredibly interesting for a host of reasons, not the least of which is, allowing a greater number of people to buy some of these types of assets and things that they don't have access to now. And it was interesting to see the SEC loosening up their accredited investor definition last week, right? It is like a new operating system for finance. And the question is, how long will it take us to get there?
So I also think that it's going to help with the inequality gap. So interesting enough, Cayman Islands has been a leader of this whole digital space because all the law firms, all the legal regulation, everything got written from here. So there's a lot of people on island who kind of understand this at core. One of the guys who's involved partly in this space, but also property and everything else, called me up the other day and said, hey, listen, I'm thinking of tokenizing real estate here. And I'm talking him through. See, so we've got the same problem as everywhere else. We've got a rich-poor divide. It's not as big, but it's there. So very simply put, it's all the property everybody makes money out of property in this country, really. But the property on the beachfront, 7 Mile Beach, is super expensive. Mm-hmm. So unless you're a wealthy, rich family from the Cayman Islands, if you're one of the young kids, you can't afford it. So tokenizing, the ability to tokenize for the pension fund market here, for all of Caymanians to participate in the overall boom in property. So you can have a stake of this hotel going up there and that super high-end development there where the apartments are $10 million. It completely changes the game because everybody can participate in the same wealth creation opportunities. And I think that's true globally. I mean, because think of all the young kids who can't afford London or New York real estate or San Francisco real estate. Well, that can change. You can have exposure to it and you don't even have to live there.
That's exactly right. And again, it is, I think that vision is fairly clear. The question is, how long will it take for those funds and for the majority of existing investors to have the ability to interact with the asset class in that way, right? And what can we do to accelerate that?
And it's probably not this wave. I think this wave has to be institutional adoption, and then it has to be the institutional investing infrastructure for this whole thing. It's kind of two waves, I'm guessing.
Yeah, and I think too, it would seem to me some degree of automation of the existing distribution process, where it effectively, at least in the first iteration, would be the same investors buying the same set of assets, but in a different form, is the thing that kind of gets the flywheel moving before you can then think about, now that I've got these assets in this new infrastructure, how can I open the aperture of distribution? What can I now do with it? But to go from zero to every person in the Caymans having, or the pension having fractional ownership of beaches and other things, again, it feels like you refactor a bit of the existing system before you can say, what does the new system look like, or what are the opportunities that the technology gives you around inclusion or distribution?
And that circles back to what you guys are doing, because unless people understand how they can custody these things and execute them and all of the things that you guys are doing, it's impossible they'll take the leap. Well, not impossible, but it's very difficult. Because you need somebody who said, look, we've solved this part for you. The bit that you're worried about, we've solved. So you need to figure out how you want to invest in it, and we'll take care of the asset.
Yeah, it's a great point, because I think, the one thing I've seen in my time in this space is a lot of people lead with blockchain. Hey, it's on a blockchain. Like there's some magical properties of a blockchain that get people excited. And I think we have to remember, and I think about a typical Fidelity client, right? They have their assets at Fidelity. Realistically, they're not going to want a totally different user experience if they own native digital assets or tokenized assets, right? They're not going to want to understand key management or go to a different website because it's a blockchain thing. And then there's their core portfolio where they can see their risk and everything else, their buying power. They want an integrated experience. So I think at some point of maturity, you're going to need institutions that, again, will make the fact that it's on a blockchain somewhat irrelevant to the end client, save for the benefits they get, perhaps around liquidity or other things. And I think that ultimately, that's sort of the objective we have, which is, look, when someone signs up for a retail trading account at Fidelity, they're not asking whether the trading servers are housed at Amazon or Google or Microsoft. Like, who cares, right? They just want a service. And for as cool as the native crypto DeFi stuff is, I think for a lot of investors, they just want the end benefit of that, and they're going to want someone who they trust to make it very easy for them in a form factor they're very familiar with, right? I want to see my fixed income, my equity, my private investments, my digital assets in one screen.
Yeah.
Right.
Another thing I was just thinking about the DeFi thing is, look, any of us have been around capital markets long enough know that you've got to go through a full credit cycle before you can figure out what the rate of return is. Everyone's going, look, I'm making 100% a month or whatever crazy numbers.
Right.
No, you have no idea. One already failed, and we don't know embedded risks. So yes, people are having a lot of fun with it, but people have to be kind of nervous because you need to go over at least a full cycle before you understand what the final rate of return is.
That's right. But the one thing I think is amazing, though, is just it's almost breathtaking, the amount of innovation and how people are thinking about this and the people that are committed to creating this new ecosystem.
And I love the fact that the engineers come at it completely different than us finance people.
Yes.
They come at it a problem solving, not okay, this is how we've done it, let's adapt it. They're like, no, forget that. You could do it this way. It's much more efficient. And those two things together, I think, are super powerful.
Yeah, I mean, that engineering mentality, which is effectively, there's no problem that can't be solved by technology. And like, to your point, I don't care about what happened in the past. There's just a problem to be solved. To me, that is the most amazing aspect of what's going on in the ecosystem and why it's attracting such talent. And it's going to be hard to say what wins out. I'm pretty confident that we'll live in some hybrid environment that won't be traditionally DeFi nor traditionally traditional. And, again, it still comes back to the user experience. Like I had this epiphany, not even an epiphany, it was just a common observation when a bunch of us at Goldman, we downloaded, wallets to our phones and we were sending Bitcoin back and forth. And I immediately thought to myself, there's no way in heck that my mom would ever buy a coffee at Starbucks with this thing, right? There's just no way ever. I mean, maybe, but the fact of the matter is that there's still a lot of work that needs to be done in terms of the interface and the user experience.
Well, I don't know if you followed the digital revolution in India, and I followed it really closely because it's like a parallel universe, right?
Yeah,
non-blockchain, but hyper fast, incredible KYC built in, this thing called India Stack and Aadhaar and the biometric record. I mean, I'm half Indian, I spent a bit of time there. People can buy a pint of milk with a fingerprint now.
This is the Aadhaar. It's the government ID system. Yeah, I mean, that is brilliant when you can build something like that. That's a perfect example. It's like, well, first of all, you could argue that there was no national, and maybe there was, but it was a very antiquated identity system, maybe non-electronic in many respects.
Yeah.
And to leapfrog right to the new technology. I mean, it's sort of like, I lived in Asia for 4 years, and look, I was in the middle of Vietnam and had better strength than I have like walking around my block. Because right, they went from not having phones to having a great mobile network. And so that's what's really incredible about some of this technology. And India is a classic example. And I think that story is a little bit underreported or maybe underappreciated because all you hear about is what goes on in China. And when you think about their mobile payments and the fact that if you said to someone in China, hey, have you ever written a check for something? They'd be like, I have no idea what you're talking about, right? Because they went through the same sort of iteration in their financial system. But what India's done is quite impressive.
Well, because the India Stack with the embedding of KYC, because KYC is the bane of our lives now, right? It's miserable. I recently opened a new crypto account with somebody else, and it's the pain you have to go through, particularly when you live on a small island. It's bureaucratic, getting all the KYC stuff. But that's all solved in India now because all your government KYC is now attached to your fingerprint or your retina scan. So you want to buy a new mobile phone plan, just go in, do that, and it's done.
Yeah.
Even your medical records are now transferring onto it. So if you're unconscious from a car accident, just take your fingerprint. Okay, here's the guy. This is what. Some people don't like it because it's kind of heavy state-handedness. Yeah. And it's centralized. But it just shows how fast the digital world is moving forwards, even outside of this whole blockchain, Bitcoin, crypto world.
Agreed. And in India, it's interesting. I mean, is your perspective that the potential privacy concerns were greatly outweighed by the benefit of having this modern,
I think because it's an open platform, to open source. So everybody's building on top of it. So I think the private sector will solve the issues of the database security. And I get it. Maybe it's not as good as blockchain and a distributed database, but it's better than nothing.
Yeah.
It really does help huge amounts of people. Yes, they banned cash and that looked terrible, but really it does change both the country's ability to tax its citizens, which is a problem in India, and secondly, for citizens to access services that they couldn't access before, particularly banking. Because without banking, they couldn't get mobile phone. Without mobile phone, they can't trade their farm goods. The whole thing was a structural mess.
Yeah.
And, it is good, and let the private sector build on top of it. I think, there's definitely a technology revolution going on in India, and let's see where it develops, because, now Facebook are building a payment system, and everybody, because they got this UTM payment system as well, which is super fast and basically decentralized. So there's no middleman in the middle. The payments go from bank to bank instantly. So it's happening. So it is a digital world. It's not just about Bitcoin and blockchain.
Yeah. And what's interesting too is when you think about, I know a lot of blockchain has been, or Bitcoin and digital assets have been couched in terms of generational, call it attitudes and differences. And I think it's been borne out by some surveys, but it is very interesting, whether it's in the US and interest in the space, or in India, or some of these countries with fairly young populations, getting accustomed to some of this technology makes them more apt to change the paradigm in the future, right? That is their native way of operating. And again, for many of us who've been in institutional finance for a while, it's hard to see that when you're inside the castle, right? Or the fortress to some degree. But there's a lot of change happening, and some of it is, like you said, very foundational, which I think augurs well for people thinking about interacting with investments and capital markets in a different way than they perhaps have thought about in the past.
Yeah, even the simple thing that most of us didn't open our eyes, and I certainly didn't, because I don't have kids, but everyone's got kids, and everyone's kids drive them nuts because they're on Fortnite all day, right? So and nobody got it until everyone went, oh my God, they're living in a fully digital world, interacting with their friends and buying and selling digital assets using digital tokens, and we're all trying to figure this shit out, and they've figured it out years ago, and they have no problem with it.
Yeah.
We're like, oh God, obviously. Yeah,
it is fascinating. Like they could not articulate it that way, but yes, we can, and it's fascinating.
Brilliant. Tom, really, really good to speak to you. I think it was a really interesting conversation. I think people are getting a good idea of where this space is going, because as you identified, the institutionalization of this space is probably the next big story, and it's going to take time, and I think it's important for people to see how this whole thing develops. So really appreciate you coming to talk to us.
Pleasure to be here, Al. I really appreciate you having me on.
Yeah, and we'll get you back to talk about the story as it evolves.
Wonderful.
All right, Tom. Thanks so much.
Yep. Take care.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.